Hey, how you doing, good people? Welcome back to Stock Up with Larry Jones. I am back. Hey, listen, go ahead and follow the prompter below if you're not already subscribed. Just make sure that it's darkened when you click it, okay? Hey, we have a lot of data to discuss today. We're going to be talking about the PPI and the CPI and actually what's coming out or what's coming up even tomorrow. Today, the Fed will be releasing the minutes. And then tomorrow, Thursday, the actual CPI numbers come out. But earlier today, the PPI numbers came out. We're going to be mentioning that. Before we get to that right quick, just make sure you click the link below. Today is a Weeble Wednesday. That's where you got the fractional shares. They got the get 6+1 free. So the PPI numbers is what a lot of people want to know what it is, okay? So if a number comes out and it's a number, it's just a number at that point. So it's just a number. So we need to know, what do the numbers mean? So I am going to make this video about what do the numbers mean. Let's start with PPI and actually what it is, right? So here it is. PPI, which stands for the Producer's Price Index, measures inflation from the perspective of cost to industry or producers of products, okay? But it actually measures the change, all right? So here it is. Because it measures price changes, remember that, before they reach the consumer. Some people see it as an earlier predictor of inflation than the CPI. So I actually look at the PPI because it measures, like it said, inflation before the CPI numbers come out. And who are the producers? The producers of products, food, energy. These are the producers of these. And then we'll get into the PPI, which is the CPI, which is the Consumer Price Index. Remember, PPI is Producers Price Index, and then CPI is the consumer. So you got the producer index, the rate of change, and then you got the consumer, right? So the producers prices actually change before it hits the consumer. So just keep that in mind. You guys know me. My theory is talk to me like I'm 3, right? So I like to break things down to where we could understand it. Now, the PPI numbers came out and they were hot. They were higher. And the market started to react positively. Let's take a look. Here's the the PPI. Services, foods boost U.S. producers price. Some relief could be on the way, says writers today. Writers, always. Some people say rotors, writers, whatever. You New Yorkers, you got another way you say it. All right, but listen. So it came out high. So Larry, why did the stock market react positive after that happened? It's cooling off now, but it started to remain positive. Because it all goes back to the Fed. Remember, the Fed. So if it shows that it's going up, and so remember, if PPI, the Producer's Price Index, is going up, and if a CPI, the consumer, starts to buy less because the Producer's Price Index is going up, then that means that the Fed could be less hawkish and more dovish. So bad news equals good news. Follow? PPI, it measures the rate of change that the producers have. CPI is the consumer, right? And the Fed reacts to both data points, right? So let's get to, I'm shooting this just before the CPI minutes come out. And what I'm going to do is listen to it and air it. I'm going to record it as it airs, and then I'm going to come back. So listen to this.
Minutes of the Federal Reserve September meeting showing that many participants stressed the need for the Fed to keep tightening, quote, even as the labor market slowed. They said ongoing rate increases were appropriate, and the cost of taking too little action outweighed the cost of doing too much when it came to fighting inflation. Once a restrictive level on the federal funds rate was reached, there was general agreement that it was appropriate to maintain that level for some time. A sizable portion of the economy, Fed officials observed, had yet to show response to tightening, even while some of the interest rate sensitive sectors had showed quite a bit of weakening. Inflation was said to be unacceptably high, the labor market very tight, and inflation was declining more slowly than had been anticipated. Maybe a few nods to the dovish side, but just very subtle nods. Several said the Fed needed to calibrate the pace of tightening with the risk of an adverse effect on the economy, and it would be appropriate at some point to slow the pace of increases, though not necessarily telling us what that level would be, where the Federal Reserve would stop. A few others here. Inflation pressures were seen gradually receding in coming years, and the uncertainty was high in the economy or in the economic outlook, but they were risks to the upside when it came to inflation. They said a wage price spiral had yet to develop, but it was seen as a possible risk, and risks to growth were generally to the downside, mostly from global headwinds like a European recession, a slowdown in China, as well as the Russia-Ukraine war. One other note here, the Fed staff did say liquidity conditions in the Treasury and mortgage markets, quote, remained low. You know, we've been talking a lot about that liquidity story here. So pretty much a hawkish Fed, reflecting the statement, reflecting the press conference of the Fed chair, with just maybe some additional concerns and commitment to keep rates high even as the labor market slowed.
This report from Steve about the minutes, is there anything in there that surprised you? It certainly sounds like fly hawks fly.
Yep, it's very much in line with expectations. The Fed is very focused on bringing inflation back down to target. And I would take it one step further. It's not just a matter of tightening as the labor market slows down. It is a matter of tightening precisely to slow the labor market down. They need to keep going till they break the labor market, because that's what it's going to take to bring wage inflation down. And that's what it's going to take to bring services inflation back under control, because, of course, services are very labor intensive.
It seems like we have forgotten that an influx of liquidity took place in the years immediately before this inflation. We had incredible fiscal stimulus. We had tax cuts, we had a huge amount of spending, and we had a Fed that was gassing it by buying securities and sending cash into the marketplace. Is this liquidity driven, or is it wage driven more? What do you say?
The Fed is going to always seem to side with the wage argument, in my opinion, but they need to be careful. Okay, if we look at the last report that we had for jobs, the August jobs report, month over month, average hourly earnings were up 0.3, Tyler, and year over year up 5.2. Why do I bring that up? Because 5.2 is definitely making a fall from its March extreme of 5.6, and just in July, we were up 0.5 on the month over month. So I see some of the wage pressures mitigating to some extent. But you're right. There's two areas that are going to be super sticky, maybe three. Okay, I think wages ultimately, but food and energy as well. And I think the latter, listen, I'm not going to get into a political debate. The latter, let's say we're going to get on track somehow, and we're going to build refineries and be able to bring enough to the marketplace to keep prices in a more reasonable spectrum. But that isn't going to solve what's going on in Europe or what's going on with Asia. So you're going to see a global fungibility factor keep those prices much higher. I think that everybody's missing the elephant in the room, and that is global slowness is going to cause many entities, whether it's the UN or other heads of central banks, to point to the one glaring issue that's causing them pain, the dollar. The dollar is up 18.5% year to date, and that is playing havoc with outside economies.
Because the Fed still sound hawkish. The market always takes a minute to, dissect information that just came out. Tomorrow morning, which is Thursday, at 8:30 a.m. Eastern time, Midwestern time, you guys know that's 7:30. I plan on being live. Make sure you are subscribed so I can keep you up to date what's going on with your stocks and your crypto, because this represents the entire market. All right, good people. Hey, if this information is helping you make your decisions, please leave me a comment. Please like the video. While you guys are at work, I want you to stay fed so you could make money. Money, 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 money. Hey, and just remember, this is Weeble Wednesday. Make sure you select my link in the bio. That's the top link on today's video. And that's where you can do your fractional buying and reoccurring. So set it and forget it. Then after that, underneath that link will be Moo, and that's where we're cashing up and getting ready for the hard recession. I always say the upcoming recession, but that's the hard recession. We're already in a recession, okay? Leave me a comment if this has helped you. It is good to be back with you guys. I love you guys. Live, love, laugh, and learn.